Even trabajo de yeah, but now we have exactly. Okay, yeah. So
We don't have social media website. No, because I was trying to feature you guys.
Yeah, once again, actually, we're going to come back to the website. Maybe we'll contact who has the
I'm saying that I can see the measure
Yeah. And then it's done.
Meaning is your responses
Do you get to learn how to make a video?
We get to
It's what? Yeah, it's working.
It is important, but I do still believe that geography, culture, and other factors affect you. If you can study
this is weak, then you just say,
now I understand why they make us think stream because this one teaches you politics, right? So it teaches you how to get which is really interesting. And then the other one teaches you economics. You know, so the first term was about like an introduction of overall topics, you know, which was very general. But this term you would learn.
Thanks so much.
Yeah, but the class don't exist. So this class don't exist. Yeah, there's some, yeah. So I didn't go on that because this year we have several guest speakers and you know Duncan Green.
So I'm going downstairs. Yeah. Rodrigo, can you come for a second, please? Is it on?
Yeah.
Okay, I'm just looking at the.
Yeah.
Okay, so if you need if Alex needs any help or something, just make sure that I'm going to bring Nick.
Okay, sure.
And yeah.
Okay. What time is it? Okay, we're at 10 minutes.
Yeah. Yeah. Do you want to maybe we'll ask people to come to the first rows?
Yeah.
Is that today? Do you want to the bus watch? Yeah, it was amazing. That was the coolest. That was the best. But I love it though. Like, it's like, to be ambassador, I'm not politician. Yeah, it's very easy. Like you could material vision, you know, like, they're very formal, and I'm like, these guys are so cool, like, people just sharing their experience, and probably like opening up, you know, how real, yeah, to be real on the topic that, you know, and then we go and talk about the family, the weather. No, he was like, in general, we talk about beautiful India, family, the weather.
Do you mind hearing the filter while
He was sharing how they do it, you know, how stuff he did, and you know, go around the bush a lot before they talk about the actual issue, you know, because of cultural issues. So I thought it was very cool. They might be sharing that for you now. Yeah,
Or I'm gonna be right.
Yeah, you need Excel and so I don't show
Yes,
I mean, you can't do it by hand, you need Excel.
So do you know how to do it? So do you have an idea of how to do it?
No, have to think about it and I'll do it.
So it's easy. See, basically it says that in 2000, it is cost 2,000 even per housing unit install a spring system. The one gets during so and every year annual maintenance of 50 hours per house for 50 years because the cost is you have to evaluate it. So it's like in year one, your total cost is 2,400. That's your total cost. And every year your cost is multiplied by 3,000. So you will have a cost. Year one. 6.6 million, and then every year until 2,600. So then you just in Excel you use the formula NPV. The rate of interest is 3%, 3%, and all the
I don't remember, but I don't have idea. It was like
so by doing that, you will know the NPV of the total cost of installing the sprinklers. So then because calculate the benefits. So a good way to make the Excel would be make those weekends. So you make all that, like all the columns, and then below the column, on the left, calculate the NPV of that row, and then make benefits, then calculate the NPV of that.
What?
They went back.
Until the
How was
weekend.
that?
Terrible.
Did you go in their family or something?
Only Saturday. Only Saturday. No. You don't know. That Friday, I stayed with them. I just
No, that's the issue that you want to
We are very efficient.
Oh my God.
Oh my God. All that you can know that you can think, everything. But so after all this emotional breakdown of this energy that super energy consuming after the game, I feel like super the complete turning point. So I really need to that
So will you go back to Sweden?
And you guys maybe addicted to going to I go to like national something for like long night. I just because they want to
I can understand everything. I just,
those are the words. I mean, not the best, but they are so bad.
government and doing this for government is gonna take
Do you guys want to
so, I do my time.
Oh my God.
So yes, the things are gonna be
Final last year? Oh, okay, so the game in Paris was 1-1, right? So in the Champions League, if you tie, if you have a tie game, go.
So if you need anything before this, let me know, and this is for you. And
But this is the one that changes.
They were 0-0.
yeah, here.
And they were 1-1 Paris. So Chelsea won 0-0, right?
Would you like to?
So they
Want to wait till 6 o'clock?
Yeah, we're on air.
All right, I remember that.
So yeah, this will wait for a minutes.
Okay, great.
They were with 10 players, 0-0. 80, you know, like 10 minutes to go. Chelsea scored. So there's 1-1. So they if they screw it up, what's the?
I hope you're not a chance. I was there. I'm listening to the. I was there. I'm fascinated to hear you
Oh my
describe it.
God, that was the most exciting game I've seen in a while.
Yeah, it depends what side you're on.
That's right. I'm not in any side, so I was very good football. It's yeah, he's not considered the best player in PSG. That's ridiculous. Okay, for Chelsea. And then 10 minutes to go. And then Thiago Silva saying they had called the penalty. Heads it, it scores for PSG. And that's 2-2. So PSG.
That's good.
In the last 5 minutes of the game. So more defense. Oh, it was just in the. I don't know.
Interesting. I think Nick was the mistake. So I saw some of myself in him. Just like our patience. That's something we really felt every time I work somewhere. I just want to get up and go and do something else.
Yeah, I went to a lot.
Like you know, like 4 things about this.
There's 2 TVs, and there's
It's so good to have like
the English
and it's free to be different role models. Just out of the box.
We're going to moderate the discussion after.
Okay.
So then when Q&A session is
Should we start?
Hi, everyone. Thank you for joining us. The LSE Impact and LSE Student Union 180 Degrees Consulting are proud to host Mr. Nick O'Donoghue, Chief Executive Officer of Big Society Capital. Big Society Capital is the first independent financial institution with a social mission set up to help grow the social investment market in the UK. This is the second event in a series of talks about the impact investing and social finance space. After learning about Social Finance Israel the previous month, this talk will reveal the supply side of the impact investing market in the UK. Mr. O'Donoghue will present Big Society Capital, and after the break, we will follow up by an in-depth dialogue with the group of MBA students from around 7 p.m. LSE Impact is a group of the Master of Public Administration, MPA Student Association at LSE, interested in learning more about impact investment and educating and connecting fellow students and alumni to the industry.
LSE 180 Degrees Consulting Society, it has two parts to it. So it's set up as a pro bono university consulting. We consult for charities and NGOs, and also in our role as a society here at the LSE, we see ourselves as the main sort of voice for undergraduate students looking to go towards social impact, looking for those kind of measures. Right. So here's a few interesting points about our speaker, Mr. Nick O'Donoghue today. So as Chief Executive, he helped establish and launch Big Society Capital. Prior to taking on this role, he was at JP Morgan, latterly as Global Head of Research. He was responsible for the firm's equity, credit, interest rate, FX and commodities research groups, in addition to the economics research department. He was also a member of the management committee of the investment bank and the executive committee of JP Morgan Chase.
Mr. O'Donoghue was a senior sponsor for JP Morgan's Social Finance Unit, which invests in and delivers capital market services to social enterprises around the world. He co-authored the Impact Investments, an Emerging Asset Class, published by JP Morgan and the Rockefeller Foundation in November 2010, and he is a board member of the Global Impact Investing Network. Jay. Thank you, Mr. O'Donoghue.
Thank you, Dan. Thank you, Alex. Thank you all for coming. It's really nice to be here. As I said, we're just down the road, actually, on Fleet Street. So it was a relatively short walk. I think I should probably sort of comment on how I got into this whole field in the first place, because as Dana mentioned, my background was, I was a long time at Goldman Sachs, I was a long time at JP Morgan. And really it was about 2007, 2008, JP Morgan made a decision to start a social finance group, and it really had no more logic to it. And I suppose you think when you look on the outside, you think of these big firms as having huge sort of strategic plans and everything is highly thought out and carefully executed. The social finance team at JP Morgan was not one of those things. It was really more of a whim on the behalf of the chief executive, Jamie Dimon, who had somebody actually who had been on a sabbatical for a year with a group called Ashoka, which is a well-known group of social entrepreneurs, support social entrepreneurs, and came back and said, you know, Jamie, I really don't want to work for this bank in a traditional role anymore. I want you to start, I'll only stay if you start the social fund, actually, particularly with LSE, in fact, LSE graduate. And I'll only stay if you start a social finance group. I don't think either of them really sort of understood what that was, but it's sort of the chief executive wanted her to stay. So So he agreed to do that, and he agreed to allow her to hire 2 or 3 people, and he agreed to give her a sort of a small amount of capital which she could use to invest. And at the time, he needed somebody who was sort of at a management committee level at the bank who would take responsibility for supervising this what was going to be a very small group. So somebody who could sort of spend 5% of the time looking after this thing. And so that's where I got involved. Should I stand here so they can see? That's how I got involved in. I got asked to do that role, and at the time I was the global head of research. And what I immediately became fascinated by this idea of whether it was even possible to combine financial return and social return. The more time I spent, again, originally I was intended to spend sort of 5% of my time. I ended up spending a lot more of my time with this particular group. Again, because I think, and this was sort of 2007, 2008. We were right in the middle of the financial crisis. There was a general disillusionment with finance and with banking, and it was clear that there was a need for some sort of new way of sort of doing things and thinking about things. And social finance at the time, just even though it was really undeveloped, seemed to potentially offer that. So that's how I got involved. And then because I was head of the research department, I was able to commandeer, we had about 1,000 analysts at JP Morgan around the world. But because I was head of that group, I was able to commandeer some of the analysts to spend a bit of time working in partnership with the Rockefeller Foundation on really looking in more detail at what was, I suppose, christened in 2008 as impact investment. And that's how we ended up publishing a report in 2010, which you referred to, on impact investing, and suggesting that it was a new asset class. And I think that sort of, I think, caught a mood. And I think the fact that JP Morgan were prepared to legitimize it by working with Rockefeller Foundation wasn't the only thing that that sort of started the movement of the impact investing movement, but it was certainly one of the sort of important milestones. And it's been, and then subsequent to that, that report was published in 2010, and as a result of that, it brought me into contact with a guy called Sir Ronald Cohen, and I don't know how many people in the room are familiar with Ronnie Cohen, but he was sort of a legendary figure in the venture capital movement in this country. He started a firm called Apax, which today is started, I think, in the late 1970s. Today, Apax is one of the largest venture capital private equity firms in the world. So he ran that for a number of years. Became interested in social investment, and I'm going to use the word social investment and impact investment interchangeably. Impact investment is a term that was developed as a result of a meeting actually that the Rockefeller Foundation hosted in 2008. But typically, Americans didn't like the word social at the time. I think they've become more used to it now, before social networking and so on. But they had sort of rather a left-wing sort of connotation. So they preferred the term impact investing. In the UK, largely as a result of the work of this guy, Ronald Cohen, they tend and still tend to use the word social investment. Broadly speaking, as I'll talk about, they mean roughly the same thing. And and Ronnie got involved in this movement back in 2000, when he was asked by the then Chancellor Gordon Brown to set up what was called the Social Investment Task Force. And they made a number of recommendations in the Social Investment Task Force geared towards trying to release capital, if you like, into supporting the social sector. So anyways, as a result of my work at JP Morgan and the research that we did, that brought me in contact with Sir Ronald Cohen. It also brought me in contact with the government, which was elected in the middle of the new coalition government had been elected in the middle of 2010. And one of the ideas that Ronnie Cohen had really way back in 2000 was that there was a need for a financial institution that would help develop this market in the UK. that was an idea that sort of lay dormant for a while until they figured out how to fund it. And then about 2007, 2008, they seized upon this idea of dormant and unclaimed bank accounts, and they used that, and I'll talk about how that works later on, but they used that to fund, sort of facilitate, if you like, the direction of funds to this social investment bank. Now, for various political reasons, it didn't get done by the previous Labour government. It was, though, picked up by the Conservative in the Conservative manifesto, and when they came to power, they determined that they could launch this institution. And so that's, and I suppose I sort of feel I was in the right place at the right time, in the sense I'd done this work at Social Finance. I knew Ronnie Cohen. The government went to Ronnie to ask him to sort of help write the blueprint for it, and I happened to be, as I say, in the right place at the right time, and he asked me to work with him on that. So he was the first chairman, I was the first chief executive. So that's how I got involved sort of full time in this movement, and it has been. And I sort of tell that story because as you all enter into your careers, I suppose the message is, if you're really lucky, once in your life you'll get the opportunity to do something that's really unique. And if you get that opportunity, take it. Because, and it won't necessarily, I was very lucky, for me it came at the right time. It won't necessarily come at the right time for all of you. But it is, you know, that's what you go to great universities like this for, to create the opportunity to get a chance like that. And so we've spent the last 4 years at BSC, first of all in the setup sort of a phase, and then subsequently trying to, for the last 2.5 years, running this organization, which, as I say, is quite unique, as Dana knows, which showed me a couple of times. We get regularly visited by, you know, by groups of people from all around the world to understand how we do what we do and why we do it, and so, as I say, it's a great privilege to be responsible for it. But so let me talk a bit about social investment, and because I think it's and again, we use social and impact investing rather interchangeably, but because it is a movement that I think over the last 5 years has acquired enormous momentum. I think there is a risk that there's been more hype than reality in the market, and I think we have to be realistic both in terms of what's happening and what the time frame is. But it is nevertheless potentially a very important movement, because it forces people to really think more carefully about why they make the investments they make, and what really is the impact that investments create. Definitionally, and many of you in this room may have already heard this, but most definitions, and this is the Global Impact Investing Network, which I'm a board member, is the principal network for impact investors around the world. This is their definition, and I think although there are some other definitions, they broadly center around the same broad themes. That social investments or investments made into companies, organizations, and funds with the intention of generating social and environmental impact alongside a financial return. And that definition contains 4 important characteristics, none of which are necessarily in themselves easy to define. And there's a certain ambiguity in a number of these, which we'll talk about. But what you see in any definition of social investment is the concept of intentionality, because there are today, in a normal year, there are $20 trillion of investment decisions made around the world. So somehow, people are sitting down investing over a course of a year, $20 trillion. Very few of those are made with any intent other than to maximize a risk-adjusted return. So, and that, as all of you who study any investing will know, is the basic question that you ask yourself when you make any investment, and you try to, in a theoretical sense, optimize along some sort of efficient frontier, you optimize your risk-adjusted return. impact investments are made with the intention of creating a social return. It is the case that in many of the sort of the $20 trillion I talked about, there will be there'll be externalities of all types. There'll be positive externalities and there'll be negative externalities. Some of them undoubtedly will have significant positive, will create significant positive externalities. You know, you could argue that an investment in the mobile phone industry has created enormous positive externalities, because today everybody, you know, 3 or 4 billion people around the world have mobile phones, and it really is revolutionizing the way people move money around and receive information, and manifestly changing people's lives. But investments in mobile phone companies are not, even though you can argue they create a positive impact, they are not impact investments, because the people that made them or the people that make them don't make them with the intention of creating a social return. So that question of intentionality is very important, and it's why, as I said, it's easy sometimes to get caught up a little bit in the hype, but the mainstream investment market today is $20 trillion a year. The impact investment market I think in its broadest sense might be $70 to $100 billion a year. I mean, that would be a very broad a measure of the impact investing market. So it's a very small part of the overall investment markets. So intentionality, investment with return expectations. So when you make a social investment, you expect at the very least to get your money back. You also expect ideally to get some sort of return. Question mark over whether that's a commercial return, we'll come back to. But it is and it's funny how one of the things that you learn when you sort of have the experience I had, which is to go from the financial sector, where in the financial sector, everybody understands what an investment is. You give somebody money, they give it back to you at some point in the future with some return on it. That's what an investment is. If you go into the social sector or talk to people in government about investment, they would consider making a grant into a deprived part of London for the purposes of building houses or helping young people education or whatever, as investments, and it's a perfectly legitimate use of the word investment. You give somebody money, they do something with it, it improves a community or improves somebody's lives. But that's not what we talk about when we're and I think actually that is at that very sort of basic level causes a lot of confusion within when I talk to, particularly to the social sector, people who run charities and social organizations. From the very beginning, they miss their notion of what an investment is quite different from what mine is as a finance person. In impact investing and social investing, the idea that a return of capital is sort of a given, or I mean, there's a risk associated with it, but it's sort of a non-negotiable aspiration, I think is quite fundamental. There are also a lot of very worthy investment funds that actually target, and I'm familiar with people like Acumen in the United States, or Venturesome is a fund here in the UK, and they'll tell the people who invest in them that they will not return the person's capital, so they will lose money. Now, personal view is that there's no market for negative expected return, and what we can all, and I wouldn't want to be quoted on this, but I mean, when you look at all the people who try to position their funds, look, we'll do really good things, but we won't actually get your capital back, almost inevitably you find they're very small. And almost inevitably you find the people who give them money are people who are doing it as a substitute for philanthropy. So they're looking at it as a better way of doing philanthropy rather than a way of attracting substantially more funds over and above philanthropy. So the impact investing community starts with this idea that there needs to be a return. There's an ongoing debate about whether or not that needs to be or can be a commercial return. We can come back to that. But the range of returns is and one of the things I mentioned our earlier report about impact investing in new asset class, that was actually very controversial for a number of reasons. One of them was that we were describing it as an asset class. And if you read around the investment or sort of the social investment and impact investing literature, that's one of the things you'll see all the time. Or one of the questions, is this really an asset class? And I think the reason that we at JP Morgan and Rockefeller decided to call it an asset class was because we felt that, well, first and foremost, we thought it was a pragmatic thing to do that would catch people's attention and potentially grow the idea movement more quickly. But also because we felt that I mean, actually a lot of things are defined as asset classes. Hedge funds, venture capital, private equity are defined as asset classes. So really, from a very purist point of view, they're either equity, debt, real estate, whatever. So I think I think most people now consider impact investing more to be a way of thinking about how it's more of an approach to investment, and it goes across all asset classes. And indeed at BSC, we've found ways in almost everything except public equities. We found ways of investing money in whether it's public bonds or credit or private equity. We have found, as well as things like social impact bonds, we found different ways of investing the money across a range of different asset classes. What makes you different is the way you approach the investment and the questions that you ask when you make the investment. And there is obviously a range of returns, and those returns are a function of the asset class and the risk of the underlying asset class, but they're also to some extent a function of the impact that you're trying to create. And I think there is, I think most people would concede there is some trade. If you want to be an impact investor and you want to create meaningful impact, you are almost certainly going to have to accept rates of return that will be below what the normal commercial adjusted rate of return would be. And the final important element of the definition of social investment or impact investment is this idea of measurement. And it's sort of a given that if you're going to claim to be making an investment on the basis of earning both a financial return and a social return, it's just a sort of a given that you better be, we all know how to report the results of financial investments, but it's also a given that you need to be able to report the social impacts that you're creating. That, frankly, is the hardest part of impact investment. I guess if I was honest, I'd say over my sort of 6 or 7 years involvement in this, it's the area that has had the most money spent on it, the most research done, and has made the least progress. And I think there's some very good reasons for that, and mainly impact and measurement is really hard. It's not only really hard, it's also, impact is different for different people. It's sort of in the eye of the beholder. So whereas $1 is $1 for everybody, it's the same thing for everybody. And I might put a really high value on providing clean water to a village in Africa, and you might put a far higher value on helping a young person in East London get a job. And they're legitimate, they're both legitimate social outcomes. But trying to compare which is more valuable than the other is really a function of what your own personal desires are, rather than the specific. So for us, when we do multiple impact investments across a lot of different issues, aggregating the impact, comparing the impact of one to the other is really very hard. So I think it's much more important to think about, to start with who are the people. If you're an impact investor, you're trying to help somebody. Who are the people you're trying to help? Why are you trying to help them? What are these outcomes? So what are the outcomes that you're trying to create? What change are you trying to create? And what are the metrics that you're going to use in order to decide whether you're going to be successful? And so every time we make an investment, that's where we start with. We have a mission to help vulnerable and disadvantaged people in the UK. So we start with with this particular investment, who are those vulnerable and disadvantaged people? How are they going to be helped? How are we going to measure what sort of outcome we're trying to create, and how we're going to measure it? And I'm sure we'll come back, because there's always questions on impact measurement, and it is really honestly one of the most, it's obviously a thing that fascinates universities, because it's a very theoretical, it lends itself to a theoretical discussion, but it is also very difficult. So let me talk about the broad spectrum of investments, because the other great challenge that we have sometimes is distinguishing impact investment or social investment from socially responsible investing or sustainable investing or indeed just traditional investing. And so that graphic tries to show the sort of the spectrum, starting with the traditional investment where the investor is focused only on financial returns, so seeking to maximize a risk-adjusted return and pays no attention whatsoever to what the environmental, social, or governance characteristics of the investments are. And that still today makes up, and I talked about this whole sort of spectrum being $20 trillion, that still today makes up a far and away the largest percentage of investment. As you move along the spectrum, responsible investing, and I think responsible investing, sustainable investing are probably used interchangeably. That is the idea that you do need to take account of these risks, partly because they are risks and they have an overall effect on particularly the long-term results of any company. So many of the largest investment managers today do have a group of people within them whose job it is to challenge the companies that they own on their environmental and social and governance characteristics and try to change them if change is necessary. It is, in my experience, it is in most places relatively ineffective, because in the very largest investment managers, I think it's the thing that they feel a need to do, but I don't think it actually drives investment decision making. In the portfolio managers, people actually make the decisions around where the fund is or pool of money is invested, I think are rarely making those decisions on the basis of, rarely if ever making them on the basis of any positive impact from a sustainability group. I think because sustainability and these issues present risk for companies, I think sometimes they will put portfolio managers off an investment. So they can be, they put people off because they are a risk. I mean, and you can, in a world where at some point in time we're going to get carbon pricing, if you're a heavy user of carbon, then that could potentially, within a reasonable investment time frame, be a significant negative for the company. So understanding that about a company is important. If you are a company that manufactures clothes in Bangladesh, for example, and I was on a panel yesterday with the chief executive of Marks and Spencer's, who was talking about that factory in Bangladesh that did about 2 years ago, where it basically fell down or burnt down, and there were 1,000 people killed in this factory. And his point was, look, Marks and Spencer's were not involved in that for a reason, because they have a very specific policies around the labor that's employed by effectively their supply chain. Those companies that didn't and were involved in that, the brand Topshop and others, it had a negative impact on the brand. So there are significant risks around, the energy sector, Gulf of Mexico, BP. You need to be aware of those risks if you're making an investment in those companies. I think that's much more visible to portfolio managers now than it used to be. So I think that sustainability criteria tends to drive people out of companies, but less sort of drives them into companies. Socially responsible investing, which is now has quite a large following, and almost every major fund manager offers a social responsibility, so SRI fund. SRI funds typically are a negative screen, so they basically say, look, we don't want to invest in the bad stuff, so we're not going to invest. We don't want our investments to be in tobacco. We don't want them to be in weapons companies. The problem with the SRI investment phases is that it's very difficult to know where you draw the line. And again, you get back to this values question. I mean, so somebody was telling me yesterday about they were forced to run an SRI fund, but because their principal client was the church, any company making contraceptives had to be out. So then on the other hand, they had people saying, well, actually, I think that's a really important sort of social value. So so you get into these discussions about what's in and what's out, and almost every investor has a different view on what they should put in an ad. But SRI today, SRI and sustainable or responsible investing today probably make up about an asset base of about $14 trillion. That's a sort of a base today. So you would assume with the turnover rate of that probably means there's maybe $3 or $4 trillion a year being invested in those type of investment portfolios out of a total of $20 trillion. That tells you that something like maybe 15%, 10-15% of the total investment decisions today are being driven to some extent by either a negative screening or some sort of ESG risk process. And then you come across to impact investing. And impact investing, as I said, has this intentionality associated with it. And broadly speaking, there are, I think, two very broad models of impact investing. And what we call them here, broad impact investment, social impact investment. I think I prefer in some respects to call them, the first one is more of, and this is to some extent different also when the US talk about this subject versus the UK. I think the broader definition encompasses really private companies. So it's about how do you make investments in companies, regular shareholder-based companies that have as their mission to create positive social value. And there's an increasing number of those. There's a big movement of what called B Corps in the United States, particularly, where there's well over 1,000 B Corps. So there's more and more opportunities to actually identify companies. The challenge with that area is definitional, because it is really rather difficult sometimes to say whether a company, a regular shareholder-driven company, has as its primary motive profit maximization, or whether it has social value, or whether it genuinely has a blend of the two. But when Americans talk about impact investing, typically what they're talking about is, I want my portfolio to seek out companies that are, providing education or health or sanitation in Africa, for example. And so companies that specifically have a purpose are purpose-driven. As I say, definitionally, we don't really have we have charities and we have for-profit companies. So definition that's difficult sometimes to arbitrate between those two. What we call social impact investing, which is really what BSC was set up to encourage, is really funding for social organizations. So it's answering the question of how do you connect charities with money, with capital, and how do you connect asset-locked social enterprises. So we have in this country community interest companies, we have various forms of cooperative structures, various forms of community-type organizations, IPSs. So they typically have been excluded from capital markets. So this is about how do you bring them into the capital market. The challenge on social impact investing is demand, because social organizations, by their very nature, and partly because they're asset locked, find it very difficult to scale. So we struggle sometimes. They can borrow money, but they have you can't borrow money forever. You've got to have some sort of equity to back it up. So this is the one that we probably know best because we're most involved in. There's a real challenge with many companies in trying to find out and trying to and with charities particularly in trying to find good, sensible, prudent ways that they can capture. But that's the broad impact investing world. What do we do? What do we do? Big Society Capital, and many of you may know this, but I mean, we were set up, as I said earlier, specifically to try and grow this social investment market. We have two sources of capital. We have dormant bank accounts, which actually is one of the things. When I mention what I do, the first question most people ask is, "So, what is a dormant bank? What is a dormant bank account? How does that work?" And and we have nothing to do with collecting bank accounts. We just receive them, and they are directed to us by government. But the answer is that your account will be considered dormant by a bank or building society if it's been untouched for 15 years or more. So if they haven't heard from you for 15 years or more, it gets put in this box marked dormant, and they will, to be fair, make some effort to find you. But if they cannot do that, they will move it off to what's called the Reclaim Fund. And the Reclaim Fund to date has received £670 million of dormant bank accounts, which is really quite a lot. And that is money that has been left lying around in UK bank and building societies and forgotten about. As I said, under legislation passed in 2008, that money can be potentially directed to one of three sources, but this government decided they were going to direct all of it to capitalise this social investment bank, which is big society capital. And they also arm twisted the four major UK banks to provide to what's called the Merlin Agreement, to provide an extra £200 million. So we have about £600 million of capital. And our job and our challenge is to try and to find ways to address key social issues in this country, whether they're in health or education, or with in housing, or with youth unemployment, or whatever, a whole range of issues. Our challenge is to try and find ways in which capital, as opposed to grants and philanthropy, that capital can be used to try and address some of those issues. And the way that we do that is by funding what they're called, what we call here social finance providers, or social finance intermediaries. And there, to date, we've funded about 35 or 36 intermediaries, and their role is to pass money on to frontline charities, or to, I say pass money on, I mean lend money or invest in frontline charities, social enterprises, and some for-profit companies that we consider social businesses. It's also our role, our other challenge is to find other people who will do the same thing as us. So our role is not to distribute £600 million in the most socially optimal way. That would be a perfectly reasonable goal, mission, but it's not our mission. Our mission is to take this capital and to bring in other people alongside it, invest this through this intermediary layer into social sector organizations. So we do really two things. We act as a market champions. We spend a lot of time. We pay for research. We do a lot of conferences. We try to encourage more people to become social investors. We lobby for things like the social investment tax relief. So a whole host of different. We talk to regulators about making social investment easier. So a whole range of market championing activities. And then our biggest tool is our capital. And so far, we've signed £160 million. We've received in total, because the money doesn't all come at once, it comes over a period of years. We've received in total about £250 million. We've committed signed commitments for about £160 million. And we've invested, some of that goes into funds, what you would recognize as sort of a fund of funds. Some of that goes into social impact bonds. We can talk about social impact bonds if people would like to. And the development of social impact bonds, some of it goes to provide capital for social banks. But in everything that we do, there's this, we're trying to bring other people alongside of us, and we're trying to create a bigger pool of money for social sector organizations to access. The biggest challenge we face, as I said, is one of demand, because most of the organizations that we're trying to fund, and most of the issues that they're trying to address have historically been addressed through giving them money, through philanthropy and through donations and through grants, government grants. And it's a really big jump if you run one of these organizations to suddenly say, well, that grant's not available anymore, but what is available is this source of capital, but this source of capital has to be repaid. That's a really different financial sort of challenge. And I think it takes a long time for organizations to get comfortable with that. The other thing, the other requirement that we have is, there were four basic principles under which we were set up. Transparency, meaning we're meant to be obviously tell people what we're doing. this idea that we're a wholesaler, so we can't invest directly in frontline organizations. We're independent, so our governance structure is there's no government. And I tell you, the worst thing that can happen to any investment organization is to have government involvement, because sort of investment and politics are completely irreconcilable. And any time you try to put the two together, it may not fail in the immediate short term, but they always fail in the medium and long term, because politicians have very different motivations and they can't help themselves. So I think one of the really good things that this government did was to say, look, we really genuinely do want an independent organization. So we have this independent board chaired now by Harvey McGrath. We have a group of trustees who sort of control the dormant accounts, control 80% of the vote, and they can fire the executive, they can fire the board if they wish, but they are there is one government representative on that board, on the board of trustees. Really, in order to make any significant change in our business plan, they need a unanimous vote. So government's got 1 vote in 8, and they would need unanimity. So it really would be, and obviously this is a very pertinent question for us now, because we're sort of, whatever it is, 70 days away from a possible change in government. And although we believe strong, and spent some time working on this, that if there were to be a change of government, specifically to be a Labour government, they are very supportive. We try to encourage them to think that they were the ones who thought of us in the first place. But if they, for some reason, did decide that they wanted to give all this money away, or they wanted to, in whatever perfectly reasonable way they might decide to do that, it would actually be really difficult for them to effectively change the business plan. So that's the third. The fourth principle is this one of sustainability, also very controversial. That we were given a task of preserving the real value of our capital. In order to preserve the real value of our capital, you sort of think, well, 2% average of 2% inflation. We've committed to keeping the cost of running BSC at less than 1%. So you have to cover that. So that means we have to earn an average return across our portfolio of 3%, which is actually a really challenging thing to do. And it rules out a lot of, again, causes quite a bit of tension with the social sector, because the truth is that there are certain investments or loans or social impact bonds that we simply, no matter what the social value is, we would not do, because they simply don't have they're not going to return a minimum, they're not going to get us our capital back. So those are the sort of the story of BSC. So just finally, I'll talk about some of the characteristics of the market, because we were set up. One of the things that's unique about BSC is it's supposed to be a market builder. We're supposed to build a market. One of the frustrating things about being a market builder is that everybody's got a different idea of what a market should look like. So you find yourself, we find ourselves in endless debates with individuals or organizations that believe we're supposed to do just one thing and help just one group of people. Building a market is much more multifaceted than that. And so in terms of trying to articulate, if you like, what our strategy is towards market development, we developed these sort of 4 basic strands of what is what would a social investment market, a robust social investment market look like. And the way we define them is across, let's say, these 4 strands. The first one is one where there's broad participation both by investors and investees. So we want a market that allows for retail investment of relatively small amounts of money. That's why we supported the launch, for example, by Threadneedle of the first social bond fund. But we also want a market where small community-based organizations can access relatively small amounts of money and for local or community-type projects. So that's one. So how do we judge whether we're if you like, winning on that? I mean, it is things like whether the community shares market is growing, whether there are more products that are available that the retail investor can put in their ISA. So whether this crowdfunding platforms are developing that embrace social investment. So that's the participation strand. The second thing that social investment is meant to do is encourage social innovation. So it's supposed to provide risk capital to allow organizations and individuals to try address social issues through new models. That is a risky thing to do. It often requires small amounts of capital. Very often these innovations are focused on early intervention. So government is really bad at preventing problems. They're arguably not much better at actually treating them, but they at least try to treat them. And what happens is that you get the whole government budget caught up in just constantly treating a problem. So you take an issue like dementia, for example. We could save a very large amount of money by treating patients better and earlier, keeping them out of hospital. But that tends not to happen. What tends to happen is we wait until the people have the disease, and then the cost of treating them is much more expensive. The social impact bond market is largely focused, at least in this country, on those type of issues. So if you think about the Peterborough, original Peterborough social impact bond, you think about some of the social impact bonds we've done, they're focused on addressing things like prisoner recidivism or youth unemployment. And again, they're about how do you provide capital to organizations to really work to address these issues. And in those cases, if they're successful, then the people who invested the money get the money back with some sort of return. But so the social innovation strand of what we do has largely been dominated by social impact bonds, and to a lesser extent by providing sort of capital for technology companies, so tech for good type of ideas, which tend to be more in the sort of private company area. So a couple of the funds that we funded, for example, Nesta run a fund that's largely focused on education, providing new applications to help particularly kids from deprived areas access education, and improve attainment and so on. So that's innovation. The other thing we do is a successful, robust social investment market would provide easy access to finance for charities. That's sort of, in fact, if you read much of the commentary about BSC, a lot of it's focused on that area. It's driven by the big trade associations that represent these large numbers of often relatively small charities. I think it's in many respects, the hardest part of what we do, because there isn't often an appetite for capital from a lot of these small and medium charities. And to be quite honest, it's mostly in the capital that they would access mostly in the form of loans. And for many of them, loans are not the right source of finance. I mean, and I think it's sort of an unfortunate coincidence that this idea in the UK has been launched at the same time as we have this big austerity program. Because what's happening is, and government, and in fact, all the way up to the Prime Minister in speeches, said, we know it's going to be tough. We know there are tough times ahead. We know lots of great charities are going to have their grants and their revenues cut, but don't worry, we've got social investment to make it up. And that's completely wrong. It's just, I'm sending completely the wrong message. And it is difficult if we're sort of calling out numbers and saying, what he said in the speech yesterday? It's wrong. And it's actually not helping us at all when they go around there, because it raises expectations. And capital is different from income, and has to be, and it's not right for everybody, and particularly for a lot of smaller and medium-sized organizations. And then the final thing we're trying to do is sort of the opposite, is trying to bring some sort of scale. There are some social problems. So you think of housing, for example, where community energy is another one, or renewables, where you really do need very large amounts of capital. So you have to be able to access. If you look at the housing market, for example, and the problems in the housing market in the UK, our capital is a drop in the ocean compared to what's needed. So we have to think about ways in which we can leverage in other capital, large institutions. That tends to be is quite specific in its application. So mostly it has been around housing. It has been around community energy. I think there's some potential within the social impact bond market to everywhere where there's a problem that, if it's addressed, can give short-term payoffs to government that the identifiable payoffs. Potentially, you could have very large social impact bonds. Our social impact bonds in the UK so far have been tiny. So that's and I think we'll have been successful if we manage to do build all of those things, and that will take. One of the things we always say about BSC is it's a long-term project. It's going to take, I think, many years. But I think if you look at what's happening today in the UK, there are literally hundreds of charities, hundreds of social enterprises doing fabulous work with enormous numbers of people that actually have benefited, are able to do that and deliver that and execute that because they have access to capital. And BSC certainly has, over the last 3 years, revolutionized and transformed the social investment, and people who sort of visited from Israel and everywhere else know. I mean, it's sort of the global benchmark for how you start to develop this market. So I don't think you should overstate what's been achieved so far, but what has been achieved so far is very significant, and there's a sort of a direction of travel, I think, a very powerful movement. So I'll stop there and let you ask any questions that you'd like. Yeah.
You mentioned the role of regulators. How do you think they can make it easier?
I think regulators are, I think we have to remember that the principal duty of a regulator is to protect investors. And I think it's appropriate that they take that duty seriously. And we shouldn't, and in some senses, I understand their reluctance to approve a whole new source of investments that are branded social their investor protection responsibilities don't go away because we've got this whole new class of investments called social investments. On the other hand, I think a lot of what they do around suitability. You know, if you're an investment professional in this country, you have extraordinary standards in terms of assessing your clients' suitability. Those suitability standards don't recognize the fact that people actually may want to make investments for reasons just other than pure financial gain. So I think somewhere in the regulatory framework there needs to be an allowance for that. And I do accept the regulators, the FCA, it's a very difficult balance. They are, if I compare where we were 3 or 4 years ago, there was nobody in the FCA who even knew about this subject. Now it's quite actively discussed. There are people responsible for it. And I do also think, actually, I mean, I don't know, we all ride the tube. I'm shocked by the ads on the tube now for crowdfunding platforms. And I look and if anybody takes the time, and one thing I know from having been in the investment markets for 25 years, is that if you buy overvalued equities, you lose money. And if you look at these and look at some of the stuff that's being sold through Crowdcube and advertised on the walls of Crowdcube as well, and advertised on the walls of the tube, it's frightening. I mean, and I can absolutely guarantee you that if you buy a portfolio of investments offered by the crowdfunding platforms today, and you buy it with the intent of actually making a return on it, or for paying for your pension, you will lose money. Now, there are lots of other reasons why people use crowdfunding platforms. Some of them are just for giving, some of them are for lending, and I think so. Some of the crowdfunding platforms are the credit process that goes quite so funding circles open to people. Some of them are gift type things where you make the investment and you get like 12 visits to the spa, whatever it is. That is, or a free copy of the book. That's fine, you know what you're getting. But some of them, increasingly more of them, are being positioned as being really legitimate investment opportunities. Some of those investment opportunities are in, I mean, you could look at some of the community energy stuff is actually quite, the renewable stuff. It's actually, I mean, at least there's a business model there, and a revenue stream. But the stuff that's more in the equity world, I just said the parking apps and all this sort of stuff, if you look at what you're being asked to pay for an evaluation for these companies, it's really extreme. So I think that's sort of not related to, so partially social investment, but it demonstrates, I think, the challenges that face regulators today.
But we see a lot of medical research on crowdfunding, and that could be a huge social impact area to invest in.
Yeah.
But it seems like people, these ideas are generally going to find crowdfunding, not going to.
Yeah, I think that it's just a question of what you're promising to the people that participate in your crowd. You know, if it's a research platform and your expectation is that you never get the money back, but they might find a cure for cancer. I mean, that's a perfectly legitimate thing to want to do. People give money to cancer charities all the time in more traditional ways. That's perfectly legitimate. I just worry about that piece of that crowdfunding market that's really focused on, that's really trying to sell actually venture capital, early stage companies, raise money with the prospect that you can make large amounts of money, because you know there might be 1 in 10,000 that will, but over a portfolio, you know, it always comes back. Equity investment always comes back to valuation, and the valuations are extreme. But I mention that because it highlights, not because it's a social issue as much as it's a regulation issue. It's an investor protection issue, which I know they're very worried about. Yeah.
First of all, thank you. That was really interesting. I was wondering if you could say a few words about the intermediaries, who they are, and how they're helping you to solve the demand problem.
Yeah, I mean there are I think two. Well, there are more than two different segments of intermediaries. There are organizations that run social investment funds. Those organizations are in two different types. They are specialist social investment managers. So you've got people like Bridges, who run today £500 million. So they're very significant, mostly in private equity and real estate type funds. You've got people like Big Issue Invest, who've been around for 10 years. You've got, and who probably run, Bridges is the only one that's really achieved any sort of scale of capital, but Big Issue Invest probably run 40 or 50 million pounds now. You've got people like Social and Sustainable Capital, which is a relatively new group that we funded. You've got people like FSE, which used to go Finance Southeast, again, relatively new group. So you've got Social Investment Scotland. So you've got those type of specialist groups, and then you've got increasingly bigger organizations that are starting social investment funds. So sometimes with our help. So Nesta, for example, which is a foundation, started their own fund with money from us. LGT, which is a large European bank, started a fund. Threadneedle started an ISA fund, a bond fund. So but all of those are, so sometimes the intermediary is a specialist, and sometimes it's a bigger part of a bigger organization. Intermediaries can also be dedicated, they can be banks. So there are two major banks, not major, but two specialist lenders, social lenders in this country. One is Charity Bank. We are now the largest shareholder in Charity Bank. Another one is Unity Trust. And they basically lend to social organizations. We have taken a rather liberal view in defining social impact bonds as being an intermediary, because typically they take money and then they disperse it. Peterborough, for example, funds 5 different charities and has 1 or 2 people who work spreading that money out. So that we define as an intermediary. And then we also define as intermediaries some infrastructure organizations. So Social Stock Exchange, we're now the largest shareholder of the Social Stock Exchange. We are the largest shareholder of a company called Clearly So, which is a fundraiser for social capital. And those are, we would consider, very high risk startup type investments, which, you know, where we're usually investing directly in the company. So it's a whole range of different, I mean, the definition of an intermediary in the Dormant Accounts Act is an organization that provides funding or other services to third sector organizations. So as long as we can fit into that definition, we're okay. Yeah.
So thank you. And as you studied, one of the biggest challenges is actually asking these charities or NGO to start thinking in a capital sort of a way. And I mean, considering I found it a big challenge, and I was wondering, from your experience, you come to this NGO, he used to only do some kind of impact, social impact.
Yeah.
And then you're actually trying to ask him it to become a business.
Yeah.
And how this is completely state of mind, different people, so how does it?
Yeah, I think you have to start by asking whether there's a revenue model for what they do. And for a lot of times there isn't. I mean, if you're And by revenue model, I mean, is there somebody willing to pay for the social value that you're creating? And if the answer is no, the only way I can justify this is through sort of grants and donations, then there is no role for social investment. I think, where do revenue models exist? They exist, there are many charities who rely on assets to deliver the service they deliver. And the most obvious example are homeless charities. So we've worked with Broadway, the Mungos in London. And basically the very simple application of social investment, we have set up a fund with an intermediary called Resonance. And they are out there buying 1 and 2 bedroom apartments in London in partnership with Broadway St. Mungos. It's not on the Broadway balance sheet, it's on the Resonance, it's a fund. And then once they bought the apartments, they provide them to the homeless client, who are typically sort of single mothers with kids living in bed and breakfast. And they provide them with accommodation that's far better than anything they would get if they had to go out and find it themselves, even. And B, they also provide them with a sort of support. So Broadway St. Mungo's job is to get these people, in order to fulfill their mission, they need to find shelter for these people, and then they need to work with them when they get into shelter so they can move back into sort of mainstream accommodation. So that's an example of a charity or an issue or a group of beneficiaries that need shelter, and shelter means houses or flats, and those require capital. So it's a very obvious way of another one is through enterprise. Do you have a bit, and charity shops, a lot of people don't like charity shops, but they're an example of charities running an enterprise. So you have Scope access to social investment market. They're a disability charity. They access the social investment market to basically increase the number of charity shops that they had. So they were investing in a business and an enterprise that they owned and ran. There are sometimes charities have a program that they're running, say for government, but they're not going to get paid for 6 months. So they need to bridge that payment. So that's again a reason why you might want to borrow money. Sometimes they want to participate in a program like the work program, for example, where they are being asked to take risk based on outcomes. In that case, there's a case for social impact bonds. So there are good reasons why charities should access capital. Very often they're not aware of them, or they don't think that way. But also very often it isn't actually suitable. And I think one of the challenges that we have, and partly, as I said earlier, was encouraged by the government to think about, oh, don't worry, the grants are getting cut, but we've got this social investment thing. And actually it's totally different.
Do you see, when you look at the future, that the NGO sector, the third sector, will change because of these kinds of investment? You think?
No, I think it will always be, grants, donations will always be the core of funding for NGOs. But I think increasingly they will become smarter about the way they use finance, and use finance more as a strategic tool, which traditionally they've not done. And they will understand better when and where it can be used. So I think the demand, but again, it will never be for everybody. It will always be a sort of minority.
Thank you.
Okay, so that's just about 7 o'clock. Can you all join me in thanking there? Just a few housekeeping points. Those of you on the Google Hangout, thank you very much for joining us. We're now going to stop the stream. For the rest of us, we're lucky enough to have Nick for a short amount of time afterwards, so he's going to take maybe a 5-10 minute break and then maybe ask some more in-depth questions later. Cool. Thank you.
Thank you. Thank you.
I'm sorry for the